In this video, I'm going to talk about quite an aggressive trading strategy, and that's how do we deal with and trade false breakouts. Hello, I'm David Jones and welcome to the latest video with Trading 212 that's part of our technical analysis, charting and trading course. Now, in recent weeks, I've been talking about support and resistance, which I think is really important. And we've covered buying a bounce off support, selling a failure near resistance, trading breakouts if these levels get broken and a new trend is starting. What do we need to do? And this week, to wrap up the section on support and resistance, we're going to look at something in between, and that's the false breakout. That's where a level breaks. It looks like the market is starting a new trend, but it ends up failing. These are fairly common, so I think it can set up lots of trading opportunities. However, if the false breakout doesn't end up being false, you can have a pretty big move against you. So it's more important than ever to use things such as stop losses to manage your risk. You know, if you have a problem holding up your hands and taking a small loss, then maybe trading false breakouts isn't for you. But before we get into all of that, let's have a look at the theory behind trading false breakouts. And as usual, we'll have a look at some real examples. So here's our theoretical market. And clearly we've got resistance coming in here, a level the market can't get through. But then we have a move that looks like this. We talked about breakouts last time around, but if we assume it's going to be a false breakout, it's when this sort of thing happens, where it looks like it's going to break higher, it fails, and it runs back into the range. The flip side, of course, would be down here, if the market broke lower, but then pulls back into the range. So what we're looking at really is different ways of trading this. An aggressive strategy could be, if it breaks, in this example, we're going to sell short straight away. We're assuming it's going to fail and effectively just pick a random stop loss up here. Perhaps the more disciplined approach is to wait for some sort of confirmation. So you get the break, market does that, rallies, but fails. So you could say that was the better sell signal with a stop loss above there just in case the market decides to take off. Let's have a look at it on the downside. So using the same approach down here, market breaks, rallies, have a higher low, and that is arguably the better signal if we're looking for a false break with a stop somewhere below here. I think they're definitely much easier to spot in hindsight, but spotting them in hindsight is usually too late. You know, the whole idea of trading a false breakout, or what we think is a false breakout, is that we can get in with relatively low level of risk. If it ends up being false, we've got quite a chunky potential profit. So as usual, let's take a look at a couple of real examples from recent weeks where we could have used this strategy. Where would we have placed our stop? What was the confirmation? And how would those trades have turned out? This is more of a long-term example, but I think it's a good one to use. It's dollar, Swiss franc, zero spread. And what we're looking at here is a 4-hour chart. So each candle represents 4 hours of trading. 29th of August, trades down to 94.28. The market rallies, a good rally, 30 point rally off that level into the end of August. But then about a week later, it comes back down to it again. So there'd be a couple of ways of trading this. First of all, if we see the strength coming in, we could argue we want to be a buyer anyway, with stops below that level. But let's see if the level holds. Let's just jump forwards. So we can see here the next candle does push below it. So this is a breakout. This is a breakout to the downside, but you can see we're looking at a 4-hour candlestick. It doesn't last very long. Now, if this is going to be a false breakout, we might want to wait for some confirmation. So again, let's move forward a few hours. So we're looking at 4-hour candles. So we have one 4-hour, one 4-hour, one 4-hour, where it comes back down to it. So 12 hours later, it's back down to that level, but we see the buyers come back in. For some people, that will be enough, that this brief dip below is a false break. We're going to be a buyer at 94, 90-ish, with a stop loss somewhere below 94.20, the extreme of the move. Because by definition, if it breaks below that level, it starts to look like a valid breakout. So there's the point of the break. This was on the 8th of September. There's our confirmation. And you can see over the course of the next week, it did move away from that area. Once again, it repeated basically what it had done before. So even though it did push below that level by about 10, 15 points, it ended up being a false break. We did have the confirmation and the market moved away. We're now going to look at a breakout, false breakout to the upside. For those of you who watched the weekly foreign exchange levels video, You'll be familiar with this. This is dollar yen. We've been watching this level for quite a few weeks now. We're looking at an hourly chart here. It's actually a big level from much earlier in the year, around about 114.50. Dollar yen rallies up to it the 27th of October and sells off below 113. So we see a good 150 point move off that level. It moves back up to it again, which on its own is a sell signal. But let's just walk forwards and see if this level gets threatened. So the first high back here, 27th of October, and we can see we've jumped forward the 6th of November. It does break out for an hour. This is an hourly chart, so we break out. And then moves back below it very quickly. So an aggressive trade, just be a seller anyway. But again, maybe the more patient thing, we want to wait for a confirmation. We want to see if the market rallies, does it run out of steam ahead of this new short-term high? And the quick answer to that is yes, it does. It sold off heavily after the first break, dips down to about 114.20, then rallies back up to about 114.40, 114.45 before turning down again. So if we were waiting for the confirmation, this would be the signal to sell short, suggesting it's a false break with a stop loss above those highs, somewhere above 114.75. Let's see what happened next. Now this is admittedly something of an extreme example because the market has moved so far since it happened. You know, we're now trading at the time of recording this in the low 111s. So we've seen a 300 point move off that. I'm not saying you'd have caught all of it, but from a setup point of view, you know, we had the false break, we had the confirmation where it didn't push back through. So a nice low risk entry point, trading short off that false break. So there's two examples there where it did work and it worked well, you know, but as usual, going back to what I said at the beginning, if it ends up being a valid breakout, you do not want to be the wrong side of a new trend starting. So it's really important to have those stop losses in place. You know, there are a couple of ways of trading it. You can jump on as soon as the market breaks out, assuming it's a false breakout. But probably the more disciplined approach is, again, to wait for confirmation. You know, wait for the market to at least look like the breakout's failing. Then you have a more logical place for your stop loss. See, there are so many different things we can do with support and resistance. This is why I think it is so much more important than having 20 different indicators on your chart. But don't worry, we will be covering indicators a bit later in this series. For this week, we'll start wrapping things up. As usual, any questions or comments, or if you disagree, leave us a message in those comments down below. We do read all of them. If you like the video, click on the thumbs up. And if you're not subscribed, we do lots of videos throughout the week. And of course, there's much more of this trading and technical analysis series to come. So if you click on the subscribe button there, and there's an alarm bell thing down there, if you click on that, you'll get automatically notified every time a video gets uploaded. But for this week, from me, David Jones and Trading 212, we'll leave it there, and I hope you have a good trading week.